Well, thank you very much, George, for another too kind introduction. It's almost exactly 5 years since I did this last, and watching myself do the 2006 presentation was a sobering experience in a number of ways. If any of you who've watched that, I'm sure you'll have some questions for me on some of my more determined ideas about the commodity boom. What I'm going to do tonight is just go through a quick introduction to my company. You guys study businesses all the time, so I'll talk a little bit about Burgundy as a business, the way we position ourselves, the way we organize ourselves. And then I'll move on, and I'm just going to answer the 9 questions that George gives every practitioner to answer when they come here. Then there's a couple of examples, one of a successful investment, one of an unsuccessful investment that we'll go through. At that point, we'll do Q&A, which was by far the most fun last time, and I'm sure it will be this time as well. So let's get down to it here. Burgundy was founded 20 years ago. We are value people. We are Buffett value people, which means we're the quality value trade as opposed to the statistical value trade or the dirt cheap guys. We've been highly disciplined. You'll see that in our returns. It's a bit of a different discipline from what a lot of value investors practice, though. We view this as a profession. What that means is that caveat emptor doesn't apply. If somebody comes in and buys something and it goes wrong, our response is not, tough rocks. We are fiduciaries for our clients' money. So we want to give them a good experience. Independence is an important value at Burgundy. Independence in a number of different ways. We value our independence as a corporation. We're one of the few sort of medium-sized financial institutions that hasn't been gobbled up by a chartered bank or an insurance company or a mutual fund company, and that's the way we want to keep it. I'll get more on that later. But particularly in our investment analysis and valuation, we don't use the other side of the street. We don't use brokerage analysts very much at all. We don't use them at all for valuation or anything. They have a very different agenda from what we have. We are a research firm. Everybody at the company considers themselves a research analyst first and foremost. The company has concentrated right from day one on building international expertise. Canada is a pretty small minnow in the world's ocean, 4 or 5% of world capital markets at most. And we believe we should offer our clients opportunities worldwide. That actually doesn't show the entire screen up here. Voila. Part of being a professional organization is that you're not there just to gather assets at any cost. So controlling asset growth is key. We want the last investor into our funds to have the same experience as the first investor into our funds. What asset gatherers do is attract people, usually with a great small cap record, and then migrate the whole thing until you're a closet indexing monster. We don't do that. People are the only real asset of the firm. They go up and down the elevators in the morning, and that's pretty much all there is to the firm. We have attempted to have consistency and stability and have largely achieved that. The last senior manager to leave the firm left to make room for me 16 years ago. That's what I consider good turnover. We've built depth and succession in the firm. We like to hire opportunistically. We hire people that have the right, the 3 A's: aptitude, attitude, and application, and who are interested and passionate about value investing. As you can see, we have this commitment to remaining 100% employee-owned. I think it works on a number of levels, not least because people who are good shareholders tend to want to be share owners in their own business. And I think it helps us attract and retain people. Lastly, we're always trying to align our interests with our clients, and that means that I, for example, have 95% of my net worth invested in Burgundy pooled funds right alongside the clients. So if their experience isn't everything they want it to be, at the very least, I can use the misery loves company approach. This is the investment team. It's always a work in progress. There's often turnover at more junior levels in the firm as people find that value investing isn't for them, or the buy side isn't for them, or they get an offer from someplace else, or whatever might happen. The senior group at the top has been in place for a very long time. There's been no turnover, or virtually no turnover there. We're generally organized in 3-person teams. So a portfolio manager, a senior analyst, and a junior analyst. And you can see we now pretty much cover the world. We started with Canada and the US, expanded to Japan, then Europe, then non-Japan Asia, then emerging markets. So we do one thing worldwide. As far as the philosophy is concerned, we have what we call a business approach to ownership. We don't think that stocks are slips of paper that have correlations with other slips of paper. A stock is a fractional ownership of a living, breathing organization. And if you're going to be a good shareholder, you have to learn about that organization. At the top there, protecting and growing capital are the primary goals. You've all heard the Buffett line about how, the rule number 1 is not to lose money, and rule number 2 is not to forget rule number 1. We really believe that in a big way, and I'll show you a little later what our track record has been in that. We are based entirely on research of companies and their managements. That's the entire shot at Burgundy. We therefore build portfolios based on a company-by-company basis without reference to indices or sectors. We know way more about our companies than any index committee does, so we see no reason why we should pay any attention to what they do. Our goal is to compound capital through buying and holding really good stocks. Turnover in our portfolio tends to be low. It's about 20 to 25% on average. So we're pretty tax efficient too, which is not unpopular with our clients. This is just a schematic about the approach that we have. On the top left is the quantitative stuff, the numerical stuff. Any investment worthy of the name generates free cash flow through the business cycle. What we want is a company that, if possible, can grow that free cash flow. We want companies that can invest and reinvest in their business on a very profitable basis. We want companies with sustainable high margins and strong balance sheets. So that's sort of the quality trade right there. The other side is the qualitative side, and Burgundy places a lot of emphasis on qualitative aspects of what we do. Assessing management is a big part of what we do, and we like to see management aligned with us through shareholdings, not through options, through actually owning stock. The major goal, the major role of management is capital allocation. So how they deal with that free cash flow is of vital interest to us. Economic resilience and recurring demand, we like companies that are widely spread. We like companies preferably that sell billions of things to hundreds of millions of people. That's the goal. And finally, the classic, the holy grail is companies with limited competition and barriers to entry. What we're trying to do is establish an intrinsic value for the company, then buy it at least a 30% discount to that intrinsic value. If it's less than a 30% discount, which it usually is because these are sort of extremely good organizations, it goes on what we call the dream team, which is our sort of AAA farm team of investment ideas. Company analysis, I'm going to be dealing with this in the questions. One thing, though, that I would say is a little different about us is the company visits. We believe and invest a great deal of our time and effort in meeting management, operating management where possible. Sell discipline, I think this is the same for every single value investing shop. You sell when it gets overvalued, you sell when you're wrong, which is the second one. It's just we don't like saying that actually in the presentation. And lastly, if you've got one stock bumping up against Intrinsic and another one at a big discount, then that's kind of a natural switch opportunity. I've seen this sheet. I sit on the opposite side of the table sometimes and see my competitors, and none of us has come up with a better sell discipline sheet yet. So this is not something you can really read, but it's 7 of our products with widely divergent launch dates. If you look at the right-hand column, you'll see that every single one of them is very substantially ahead of its benchmark, meaning that paying no attention to benchmarks is a really great thing. And over almost all periods since we lead, that doesn't mean that in every year we do. In fact, quite the contrary. Sometimes we get 2 and 3 year periods where we lag the markets, but it tends to come right for our clients. One thing we like to show potential clients is the annual rates of return, because some of them are pretty benchmark oriented, and we have some aspects of our business that kind of scare off benchmark oriented people. You can see that these numbers are dramatically different from the index returns. And sometimes dramatically worse. Look at 1999, where the market's gapping on the upside with tech stocks, and we're losing money. People are selling our stocks to buy tech stocks. Then look at 2000 and 2001, where we're compounding, and they're losing money. There's 2 really bad bear market years on here, 2002 and 2008, and in each case we outperformed very substantially. And that's where we make our bones. That's where Burgundy really comes to the fore, is in bear markets. As far as where we invest our money, we're about 50% invested in Canadian assets. About 40% of that is equities, 10% is bonds, roughly. Outside Canada, the other 50%, about 60% of that is in US equities, both large and small cap, and the other 40% is in non-North American, Asian, European, emerging markets. So that's just an introduction to Burgundy. So I'm going to turn now to the questions that George sent me and asked me to cover. The first one was, what principles do we apply in searching out investment opportunities for detailed study? So I already described what I called the quality value trade, which is companies with good balance sheets, stable and growing cash flows, and barriers to entry. We prefer companies with recurring demand for their products and a measure of pricing power. Our aversion to cyclicality tends to mean we prefer companies that are capital light and do not have a large base of depreciable assets. When you add this up, you tend to come up with a portfolio that has a consumer bias. That being said, when I did this in 2006, my example of a successful Burgundy investment was Cameco, which is a uranium producer, a low-cost producer that we were able to buy at half book in 2000. So we go where value leads us. Today, it's led us to kind of a surprising place. If you'd told me 10 years ago that our US equity portfolio would contain Microsoft, Oracle, and Cisco systems, I would have thought you were crazy. But they're all in there today. They're there because they're very good businesses, and at a price, they fit what we do really well. And those prices have been tending to arise. Second question was, what kinds of information and securities are we seeking? We are equity investors. We have a successful fixed income franchise and a very successful high yield product, but fixed income is only about 10% of what we do. In small cap funds, we're a little more adventurous than we are in large caps, so we buy sometimes busted converts and income trusts. But generally speaking, we buy equities. We don't invest in derivatives, even simple ones like options and warrants. I don't like investing in anything that can expire worthless. Time is on the side of the long-only equity investor, and that's not true of derivatives investors and shorts. A key part of our investment process is interviewing managements. This is valuable from 2 aspects. First, we get to hear directly from operating management about the business model and business strategy they want to follow. Second, the careful preparation we make for these interviews is in itself an advantage, since too many investors take a passive, absorptive approach to their investments rather than really thinking about what they need to know. We interview about 500 companies a year worldwide. This is the aspect of our business and process that our people like best. We're not looking for short-term informational advantages when we see managements. Our reason that we have really excellent access to top operating management, CEO, CFO level, is that we don't talk about quarterly earnings or even annual earnings. If we have questions about the accounting, we will of course ask that, but our questions are overwhelmingly about the operations of the business and above all, capital allocation. How a management distributes free cash flow among competing business needs is of vital interest to us. It will determine our return long term. Our main concern is the sustainability of the business, or if you like the way Buffett puts it, the width and depth of the moats around our castle. Third question is, what kind of investor irrationalities do we consider? We believe that quality and sustainability are generally underpriced by the market due to time horizon effects. This is increasingly the case since we've been introducing more and more market participants at the short end of the time horizon, people with an interest in immediate gratification. The hedge fund managers, for example, generally are interested in volatility rather than stability, so they rarely find our stuff interesting. And of course, the new wrinkle now is high-frequency traders who have a microscopic time horizon. In my opinion, these people don't really serve either of the two functions of a capital market, capital provision and price discovery, and somebody should take them out. Only index funds and people like us have long enough time horizons to benefit from holding stable, high-quality, low-volatility stocks. So before somebody asks, as I'm sure somebody would, ETFs don't count here. If they were only used on the long side, they would fit. But in fact, they've become a so-called risk control measure for hedge funds, and they are massively used on the short side. 70% of the canceled trades in the flash crash last May were of ETFs, which seems to me to indicate somebody doesn't really understand these products. Aside from time horizon anomalies, investor neglect is another feature we like. For example, we have a brilliant track record of investing in Japan. I don't think there's any other way to put it. There are over 3,000 listed companies in Japan, and 70% of them have no investor coverage whatsoever. The market is loathed and despised by most investors. But if you're not competing with anyone for information, any information you have, it seems to us, is an advantage. Japan's an extreme example, but looking where there aren't a lot of competitors is generally a really good strategy. Fourth question is, what periods lead us to greater or lesser investments? Now, I take it the main thrust of this question would be cash positions. I have a fully invested bias based on my early career at Sun Life, where we held very high cash positions right through the 1980s. Even in the crash of 87, we did not adjust the cash positions and invest anything. We just held it and patted ourselves on the back for having been right. In my experience, investors with really large cash positions do not tend to actually exercise the optionality that cash allegedly gives them. I'm sure there are exceptions to this rule, but generally I believe my firm is made up of good stock pickers, not good market timers. So we are going to try and keep cash positions below 10% of our portfolios if humanly possible. As for asset mix shifts, we're very cautious about those too. One unfortunate aspect of world markets over the past few years is the very high correlations that they're running. This means that real pockets of value in the world are comparatively rare, with the eternal exception of Japan. Trying to time shifts between US, Canadian, and European equities is a mug's game. So I tend to stick to long-term allocations to various markets with occasional rebalancings, so I can sell the outperforming asset and buy the underperforming asset. Such a strategy can be very rewarding, especially in a time like 2008, 2009, when all the underperforming assets you've been systematically investing in suddenly become outperforming assets. Our Asia fund, which is about 85% Japanese equities, turned in a positive return in 2008, 17% positive return in 2008. There weren't a lot of long-only managers who were able to produce a return like that in 2008. It was all currency, but I get blamed for currency, so I'll take credit for it when it goes in my direction. And it wasn't the Japanese benchmarks that did that, because we outperformed the Japanese benchmark by 26% that year. Question 5, how do we define and estimate value? Buffett divides the value camp into those who want to buy a fair company at a wonderful price and those who want to buy a wonderful company at a fair price. And we fall into the latter category. Another way to look at it is that we look for our margin of safety in the business, while many value investors look for their margin of safety in the balance sheet. As far as estimation is concerned, we use all the standard value investor techniques, but some are more useful than others, we believe. For example, book value is problematic from several different angles. The prevalence of write-offs and stock buybacks has dramatically reduced the usefulness of book value as a valuation guide. In his latest Berkshire Hathaway annual report, Buffett mentions that book value is an understated measure of intrinsic value. He uses it because it's not very volatile. But the understatement comes from more than just management actions. For the kind of companies we invest in, there are intangible assets built up over a very long time as brand value. Even the most hardcore Ben Graham types like Bruce Greenwald at Columbia will allow some modest capitalizations of things in order to try and account for brand value. He doesn't deny its existence entirely. And to adjust book value for highly profitable, high-quality firms like ours. If you think about it, you build a brand by investing in marketing, promotion, R&D, quality control, logistics, and distribution. All have to work together to create a brand, and all are expensed in annual net income. I'm not disputing the accounting because I like conservatism, but there's also the famous quote of David Ogilvy that half of all advertising expenditures are wasted, but nobody knows which half. So trying to tie these expenditures to enduring value is very tricky. Trying to put a balance sheet value on it is probably a waste of time. But these companies tend to have much lower volatility in their earnings streams than most, so we use DCFs to estimate value. I know a lot of value investors don't want to pay for anything except the hard values in the business, but we feel success of our kind of investing in preserving and building value indicates there's something to this approach when used conservatively. In evaluating the ongoing profitability of the business, we prefer enterprise value to EBIT over PE as a measure for operating businesses. This measurement incorporates a balance sheet measurement into the value assessment, and that's been a good way of staying out of trouble over the last few years. We also consider replacement value, but there hasn't been a lot of call for that in recent years, aside from at the 2009 bottom. In Japan, we have a luxurious situation from a value investor's viewpoint. Since our average investee company has about 38% of its market capitalization in net cash. Getting them to deploy that cash in investor-friendly ways has been a preoccupation of ours for 13 years now. We're making steady progress, but slow progress. Japan has been an interesting experiment for a value investor because the lack of traditional catalysts makes value realization difficult. We've avoided value traps very successfully in a country that has been one vast value trap. A little growth you don't pay for and some improvements in capital allocation can make you a one-eyed man in the land of the blind, and that's what we're trying to be in Japan. The sixth question is, how do we factor in asset values, related security transactions, industry economics, firm strategies, and management behavior? As you can probably tell from my previous remarks, the last three of these are really critical for what we do. Industry economics are key. In any industry, there's usually one player that harvests a disproportionate amount of the profit pool. In quick-serve restaurants worldwide, that is, of course, McDonald's. In Canada, Tim Hortons dominates the category. Finding that player and investing in it when valuations permit is really the key to what we do. Cyclicals are a tough place for us. We have made lots of money in them, but only when the commodities are trading at a discount to their marginal cost of production and the companies are cheap. And that has not been the case for quite a long time. The economics of these things were great from 66 to 82. They were awful from 82 to 02, and they've been great again since. But it's tougher than it looks right now, I would say. There is some real economics behind the global growth story, but I think there's also a lot of noise in commodity prices right now. Speculative interests are driving prices to an unprecedented extent. Commodity booms lead to speculation and hoarding. That's been true of every commodity boom in history. And I'm sure this is one of the greatest commodity booms of them all, so I'm sure we have huge amounts of speculative inventory on the sidelines everywhere except possibly in oil. When Chinese growth slows, as inevitably it will, we will see another crash in prices. Could happen soon, or it may be years off, but when it does, you're going to see another big mess in commodity companies. So industry economics are important to us. We also pay a lot of attention to company strategies, especially those to reduce costs. For example, Henkel, a German detergent and adhesives manufacturer, hired an outsider to set the company on a more profitable course. The new CEO has executed a cost reduction program that so far has increased operating margins by 4%. It's a very significant amount, and he's about to announce a new program that will increase margins further. Operational improvements are always the best way to create a sustainable increase in profitability. Finally, management behavior is an important variable in managing a high-quality firm. Buffett says you should buy businesses that any fool can run because eventually one will. If you have a company that produces a lot of free cash flow, someone will eventually decide to make a transformative acquisition that will probably be an unmitigated disaster for shareholders. We like companies that stay close to their products, grow organically, and keep acquisitions to the tuck-under category. On the other hand, a high percentage of the opportunities to buy great businesses occur when management does something stupid, so you'll always have to watch it on both sides. Another area to carefully watch management behavior is in compensation matters. For another example, we used to own a stock in a very fine advertising company called Omnicom. The CEO, John Wren, had been very sparing in his issuance of options through the 2000s when lots of managements were making pigs of themselves. Then in late 2008 and early 2009, Omnicom issued options for 7% of the outstanding shares of the company in 1 year, just when the stock was trading at decade lows. So the timing certainly showed that the goal of capital allocation at Omnicom was management enrichment. My excellent US equity manager, Stephen Mitchell, went down and had a very, very spirited interview with Mr. Wren, and then we sold the stock. Buffett calls issuance of options on a growing high-quality company a royalty on the passage of time. All management needs to do is sit and wait, and wealth will grow. Now, that's the approach we use as shareholders on these stocks as well, but the difference is management doesn't have to pay a red cent to participate. Seventh question is, how do we, if at all, account for differences between market prices and intrinsic values? I tend to like the characterization of the stock market as a complex adaptive system used by Bill Mauboussin, Legg Mason's investment strategist. His theory explains the difficulty of beating the market in normal times while leaving the gate open for the possibility that the contrarian investor will have opportunities to outperform. Mauboussin believes that the key to the apparent efficiency that the market shows is diversity. Diversity of opinion, of time horizon, of financing, of just about everything you can imagine. When you think about it, there are millions of market participants worldwide who are extremely diverse in attitudes, backgrounds, time horizons, value techniques, funding, everything. So this motley horde of individually irrational investors will usually find approximately the right value for equities over the course of a business cycle. But every now and again, especially late in bull markets, investor diversity declines as more and more investors get on a bandwagon, whether it was tech stocks in 99-2000 or commodity stocks in 06-07, early 08. As diversity of opinion declines and everybody strives to own the same stocks, divergences between intrinsic values and prices become acute, both on the upside and the downside, and opportunities arise for value investors. And of course, the same dynamic takes place in reverse in bear markets where more and more people become convinced of the merits of bonds or the risks of equities just as opportunities are at their peak. Number 8, how do we define and manage risk? Risk for us is the risk of absolute capital loss, permanent absolute capital loss. We don't worry about volatility, which is inevitable and variable, or variability relative to an index, which is irrelevant. Our best risk control is the strong balance sheets of the companies we invest in. The next best defense is the strength and reliability of the cash flows of our companies. We do not normally accept any rules binding us to index weightings. We will accept some diversification rules for institutional clients, like a maximum position size of 10% in the portfolio. Burgundy always shows up in the low variability side of the scatter diagram of money managers, which you've probably seen. Aside from periods of market craziness, we are always in the top left or first quadrant, as it's called. Premium return, low volatility. It's simply a function of what we own, and it comes out the tailpipe. It's not because of any, playing around with betas or any of that other modern portfolio theory nonsense. I think you can see from our track record, if you could have seen it, which you probably couldn't, that we protect the downside for our clients very effectively. To me, that means that risk is effectively controlled by our approach. The last one is, how do we make overall portfolio decisions and determine asset allocations? At Burgundy, we tend to have 3-person regional teams. All decision-making authority and responsibility is concentrated in the portfolio manager. He or she has complete, undivided responsibility for the results of the fund they run. We tend to run concentrated portfolios at Burgundy, anywhere from 20 to 40 companies per portfolio. Generally, large cap portfolios are more concentrated than small cap. Initial positions tend to be significant in the 1.5% to 2% range, usually, unless valuations are really good. A full position would be considered 4 to 5%, but we can go up to 8 to 10% in appreciated positions. Managers position the portfolios strictly as they wish. They do not resemble benchmark indices. The overall bias is to be quite equally weighted, with most positions between 3% and 5% of the portfolio. Asset allocation is determined by me. As I mentioned, I tend to like to set target weightings and rebalance to these targets on an ongoing basis. I've made some adjustments over the years, particularly when we add a new geographic area to our coverage. We're in the process of doing that with our emerging markets effort right now, which we will roll out when valuations are more attractive. So those are the questions. And now I'm going to go through quickly a couple of examples of Burgundy-type companies. Both of these come from our European portfolio, actually. First one is Schindler. Probably not a household name, but Schindler is the world #2 elevator manufacturer. Comes right after Otis, the division of United Technologies. It's a Swiss company. We really like elevators because they last for a heck of a long time, and the people that put them in generally get the service contracts for them. It's not the kind of thing where you'd call up a elevator service company and ask them to come and look after the elevators in your high-rise office building. And that revenue over the course of the life of the elevator amounts to a great deal more than on a present value basis than the initial cost. And the profits are, of course, massive, as they always are in service businesses. So you can see we've shown what we've done over time, where we purchased it in 2005, $49 a share. It was about 8.6 times EBITA. You can see the revenue, EBIT margins. One of the other things was that its EBIT margins were half of Otis's. A lot of European family-run companies have accepted, lower profitability because of stakeholder situations. But our feeling was that they were going to have to start being much more aggressive on the cost side, much more aggressive on increasing their profitability. As you can see, Schindler's been quite successful in doing that over time. We trimmed it in the low 70s in 07 and again in 08. When it collapsed in 08, we bought it back at about $53 a share. Pretty good trailing EBITDA number, but we also weren't quite sure about the cyclicality of the business at that point. In fact, as you can see, it's done brilliantly since then. The margins are expanding quite nicely. What we hadn't really appreciated was the extent to which they were leveraged to construction in China. That may prove to be a two-edged sword, but we'll see. So the original thesis on Schindler, very resilient, 80% of profits from service, modernization of an installed base. That's the other thing. When people have a Schindler elevator, they'll tend to call Schindler to come back and renovate the elevator. Global oligopoly, I think it's Mitsubishi, Kone, Schindler, and Otis have 2/3 of the market. You can see, as I mentioned, the Otis margins. We like rational family ownership of businesses. Companies that are uncontrolled tend to be controlled and run in the interests of management. And rational long-term family ownership often means that they don't bet the company. They don't have some of the pathologies that especially U.S. large caps have. Long-term record was great and a rock-solid balance sheet. So now, several years later, it was more resilient than we expected, largely because of this sort of Asian warrant that we weren't even aware we had. The margin process has been great. The profit's been growing right through the recession. And net cash on the balance sheet went from 425 million Swiss francs in 2005 to 2.5 billion today. So lots and lots of optionality in the balance sheet. That's what happens when it goes right. This is what happens when it doesn't. Okay, Nokia. Pretty familiar name, I'm sure you all know. You can see what the progression has been of their EBIT and EBIT margins. The bottom thing is probably the key. Nokia was 60% of the world's smartphone market in 2007, but we all know what's happened to the smartphone market over the last 3 years. iPhone and especially Android has been eating their lunch. So we ultimately sold it at about $8.25 a share, I think it was in December. And then they announced the Microsoft alliance, and the stocks, it's in the 6s or the high 5s or something like that. So the original thesis here was that Nokia, when we bought it, earned more than half of the industry's profits, believe it or not. Had a lot of advantages in costs, in R&D, distribution, brand. Back then, software wasn't the key, hardware was the key. And that's been a major shift in that business now that Android and Android and Apple are the big driving forces. And the rest, you can see this. We bought it when Motorola's Razr was doing really well. Some of you might remember that, ancient history. 2008 to present, though, iPhone hit them, then Android has really slaughtered them. We overestimated how quickly they could respond with Symbian, and you can see their share dropped. So the thesis is broken. We did not lose money on the stock, believe it or not. We made 14%. That's raw. It's not compound, so it wasn't a good investment. But it does show that if you have multiple margins of safety, even when things go badly wrong, you don't have to get really stomped. So that concludes my prepared remarks insofar as they were prepared, and be happy to answer any questions you might have about my company or the way we approach things or anything else. Sir. They want people to use the mics this time, because last time when people didn't use the mics, you had to wait about 5 minutes before figuring what the question was that I was answering.
So when you're hiring staff, how do you do diligence on them versus a company? And how do you build your margin of safety?
We have a situation where you interview a lot of people at Burgundy before you get hired, including the chairman, including myself, including most of the people who'd be working with you as analysts and the portfolio managers. It's actually an extremely time-consuming process for all concerned, particularly for the unfortunate candidate. We don't always get it right, but I think we know generally what we're looking for. You know, those things I was talking about, trying to get a handle on, you know, their aptitude for the job, attitude, work ethic, and just, you know, interest in the subject is key. But hey, it's not the. I think we do better with companies than we do with people sometimes. But we've got a great group of people. It's just there's turnover sometimes.
Thank you.
Given your experience with Nokia, I'm wondering if you've changed your approach at all with when looking at other technology companies like Microsoft and Cisco, specifically increasing the margin of safety or looking at things a little differently.
Yeah, it's a bit of a concern right now. I think you know, all of those other companies are challenged in areas of their businesses, but not really in their core cash flow generating. That was the big change in Nokia, was that the core business was really taking torpedoes, and there was a new entrant. You know, there's the Android thing was just a total game changer from our standpoint. We don't see that with those other three names.
Great, thanks.
So several times in the class, in value investing class, we discussed how clients could be their own kind of worst enemy during these kind of investments. Do you in any way disclose your holdings to your clients, or do you provide with the updated maybe quarterly reports of how your investment's doing? Thank you.
Clients can get their entire portfolio at any time. We report to them quarterly. Some clients like to have their entire portfolio listing sent to them monthly. We have frequent meetings with clients. Some of our really long-term clients, we have trouble getting meetings with them because they know us well and they trust us, which is not good because we actually have a requirement by the regulator, a know your client requirement by the regulator, and we have to meet with them. So we keep saying, please come in, we have to do this. So we're totally transparent to the clients. We try. We would prefer to be less transparent to the outside world. There's a lot of our positions that get disclosed by the regulator, and I think that's just part of the regulators have all these huge areas that they have no control over, hedge funds and private equity funds and all the rest of this stuff, and so they've got us, right? So they can keep more disclosure. It's total nonsense. But to clients, they own it, so they can have any information they want at any time.
So how do you then make sure that they don't overreact during the downturns and don't sell their investments too early?
In the last analysis, it's their money, but I would say, our clients are generally go through a pretty good vetting process as well. We try to make sure that they aren't buying trailing performance, that they really understand what we do, and that they're buying us for our process and our approach, rather than for our trailing returns, which of course are not available. Yeah. We had very, very few clients panic out of the market at the bottom in 2009. There were a few, all small, and all quite unfortunate, because of course they realized their losses. But by and large, our clients know that they're going to do better with us than with just about anybody else in a down market. And the difference this time was they weren't willing to invest, really. They were, private clients have had a major change in their attitude to equity investing based on 2008. There's no doubt about it. But they did not disinvest with us.
Mm-hmm. Great, thank you.
You had mentioned Buffett a few times in your speech. I was just wondering if there's any other value investors that have influenced you or that you admire.
Phil Fisher is, if you've ever read Common Stocks on Common Values, he was a great one for visiting management and getting to know companies and setting up a network of knowledgeable people. Ben Graham, of course, is where it all starts. We follow lots of people around Jeremy Grantham, Jean-Marie Eveillard. There's quite a listing of people that we follow besides Buffett. The thing about Buffett is the man is, from a communication standpoint, he's a genius. So, I can't quote Jean-Marie Eveillard, partly because my French is very bad. But Buffett is just the most quotable value investor who ever lived. And he's also a guy who became the second richest person in the world investing in the stock market. So it behooves us to listen to what he says.
Yeah, no kidding. Thanks.
You obviously have a lot of confidence in the management of the companies that you buy. So I was wondering, at what point do you sort of step back from that and actually decide to take an activist approach in changing maybe the practices that they're using?
Yeah, we had an early experience of that. We had shares in a company called Canadian Marconi back in the 90s, and they had, I think, $11 a share in net cash, and they traded for $10, and they cut their dividend. So we thought, well, that's a little weird. So we called them up, and they said, well, we wanted to send a message to the market or something like that. I have absolutely no idea what they were doing. But anyway, it was controlled by GEC out of Great Britain, which was Lord Weinstock, and Lord Weinstock had all these cash hoards all over the world, and he wasn't going to do anything with it. So my chairman, Tony Errol, we got him elected to the Canadian Marconi board along with a very prominent Toronto lawyer called Howard Beck, and they were going to go in and really try and shake things up. And it was a complete waste of time. I think if you're teachers, the big dog, you can throw your weight around in areas like that. And we sort of hang around with teachers and say, us too, all the time, because they're generally on the side of the angels, and they have gigantic resources that we don't have. But our personal experience, aside from in Japan, where we've had a very steady, slow discussion with lots of Japanese managements on capital allocation. In that case, it's not because the Japanese are stupid or dishonest or anything like that. Far from it. It's just that their corporate culture is very different from ours. And the whole thing was set up for a capital shortage environment, and now all of a sudden they have all this excess capital and they don't know what to do with it. So I would say Japan is kind of maybe a special case, but for North American companies, by and large, we use the Wall Street rule. We vote with our feet when we don't like what management's doing.
Thank you.
You discussed using a DCF instead of some of the more traditional asset-based valuations. Has that approach evolved over time? I mean, from the inception of Burgundy until now?
Well, we haven't. Look, you can. The problem with the DCF is you can get it to do anything, right? You can mow your lawn or sing an aria from Faust or anything you want. You can get any answer you want. So what we tried to do is be pretty standard about it. We use 8.5% discount rate for all large cap companies, 10% for small cap or more volatile, and 12% for highly volatile companies. So it's quite conservative and it's standard across the firm. Terminal values is another area where I think we're more conservative than most, although no matter what you do, your terminal value becomes a pretty large amount of your total. I guess so there's been, I wouldn't say there's been much development. I would say there's been more standardization in trying to ensure that we're not reaching. But it's tough. I mean, as I said, the qualitative aspects of the business are in many ways more important to us than the quantitative ones.
Fair enough. Thanks.
You said you're launching your emerging market funds sometime soon. Just wondering, given your focus on management, I assume those emerging market fund, a lot of the companies will be in places like China, Brazil. So, given your focus on management, how do you address kind of the language and cultural barriers that investing in those places will pose?
Great question. We're not launching the emerging markets effort until we see pretty good valuations, and we don't see that yet. I would say we've taken the approach where looking at let's start from the top. Emerging markets is one of the most intellectually incoherent ideas anybody ever came up with, right? I mean, there's no relationship among most of these countries. They're far apart. I mean, look at the BRIC thing, right? Brazil, Russia, India, China, 4 huge countries with absolutely nothing in common. So the very basic approach is Russia, I'm not going to invest my clients' money in Russia. China is way harder than it looks, like way harder than it looks. So we've done a tremendous amount of work on it, but we've found very limited opportunities there so far. India, I think, is a really exciting long-term prospect. The challenges are huge, but I think there's a few advantages there. One, and it's an unfortunate fact, but there's more English in India than in any of these other countries. So for people like us who value knowing what's going on, that's a big advantage. Because in China, for example, the number of financially literate translators is brutally low. There's nothing worse than flying halfway around the world and sitting opposite a management in a Chinese company and having a complete dialogue of the deaf. Like, nobody knows what the hell's going on. It's so frustrating I can't even begin to tell you. So India, you've got that big advantage. There's a lot of English around. It's also, the companies tend to be run on a recognizable basis from the standpoint of their goals, their returns objectives, and so on. the Bombay Stock Exchange is older than the Toronto Stock Exchange. So there is a very, very large shareholder class that's been around in India for a long time. There's about 3 business channels in India, and the quality of the programming, I mean, compared to the complete nonsense we get on CNBC and stuff like that, was amazingly high. Which leaves Brazil. Brazil surprised me. Brazil has had, I think, 3 or 4 currencies since I've been in the business. And so I went there without very high expectations, but they exceeded them massively. I think Brazil could be a very exciting long-term theme as well. It could be actually a way better place to get commodity exposure than Canada. Because one problem I have with the Canadian commodity markets right now is I don't think we have any low-cost producers at $1.02 US. Nothing even close, I don't think. Whereas Brazil is ridiculously low cost in all kinds of places. Like I don't think there's a place for a Canadian forest products industry long term compared to Brazil. It's just they're so insanely low cost. So of the big guys, Brazil and India, I think, are the two that we're going to concentrate on. After that, we are to some extent Boy Scouts because we're long-term investors and we want management behavior and all that kind of stuff. So we tend to go to countries where they're adjacent to large trading blocks and to people that we know well. So South Korea, Taiwan, Turkey, Israel, Chile, I think is a big theme for us. So we're still working on it, and it's a fascinating research challenge. But I think we've got a really good product. Sometimes the local subsidiary of a multinational will be public, and that's a way to get cheating a bit, I guess, to get a look in at markets in some of these countries. Like, Hindustan Unilever is a fabulous company. That's a way to get a play on the Indian consumer, which I think is going to be a big long-term thing. It's a really big subject, but we've been working hard at it for 2.5 years, and one of these days we'll get it right.
Cool. Thank you.
So you mentioned that you do just about 500 company visits a year to look into company management, and I was just wondering what it is that you look for and try to verify in the management that you get through these meetings over and above just looking at their executive stock ownership or past performance.
Yeah, it varies a lot. In the Japanese effort, for example, the Japanese language is one of the greatest barriers to human communication ever devised. So actually visiting a company in Japan, if you have an hour and a half with management, if you're lucky, you get maybe 40 minutes of communication out of it. So in Japan, I would say we have to have about 3 visits to get as much out of that as we would have from one with somebody else. So it's just the productivity is different. The time horizon's a little different. But generally speaking, we're trying to concentrate on the operations of the business. Like, for example, if you go and see Procter & Gamble, we kind of treat that as like an MBA seminar or something. So when we go to CP&G, who, by the way, generally have unbelievably good people in investor relations. Like, there are a few companies that put fast trackers, like people that are going to go all the way to the top in investor relations, and P&G is one of them. And we'll say, we want to talk about supply chain. And they'll get supply chain people from across the firm to come in, and we'll just spend the whole hour and a half talking about supply chain. One time we went in and said, we want to talk about how you use advertising agencies in your marketing strategy, those kinds of things. So, that's a little more clear example because we focus on individual things with them, but maybe that gives you an idea of the kind of things that we're looking to learn.
Thank you very much.
My question's about your asset allocation. You have a global focus, but your assets are still about 40-odd% allocated to Canada. So I was wondering if there's a reason that drives that, or it's still just a home country bias.
That's not a result of allocation. That's a result of the Canadian equities at the firm doing really well and clients hiring us for specific Canadian equity mandates.
Okay.
So that kind of comes out the tailpipe. What I was showing you wasn't what I allocate. What I allocate would be on in individual multi-mandate accounts like balanced funds or EFA funds or global funds. That would be more what I was talking about.
Right. Thanks.
Sorry.
Sorry. You mentioned that when evaluating a business, you look at the margin of safety of the business rather than of the stock. So how is that different, and how do you put a value on it? Is it qualitative, or can you measure it?
Yeah, I said the business rather than the balance sheet. So, you know, a hard assets, Ben Graham type investor would just say, I'm buying this thing at a discount to net working capital. That's my thesis, right? Whereas for us, we're buying a stream of cash flows that we think is stable and defensible for the long term, which is why we use DCFs. So that's what we mean by that. And you're right, it is more qualitative. I mean, look, 20 years ago, cornerstone stocks in the portfolios of people like us would have been newspaper stocks. And there's an industry that's just been totally hollowed out by the internet. So you've always got to be aware. You know, the nature of capitalism is that any advantage, any competitive advantage is always under attack. So, you know, you always have to be paranoid, and you have to be working on this qualitative stuff to make sure that you understand the business, really and truly understand the business.
Thanks.
Hi. You put a lot of weighting for the management team analysis, and so there's Phil Fisher. It's crucial that you have to know who is the controller the business and how is he going to do with it. Since you are an institutional investor, it's really easy to access to the management and have an interview with them. As a retail investor, we don't have those luxury. Can you give us some process how we analyze the management team without access to them?
Yeah, we're lucky in that we have, I think, pretty amazing access to senior management, especially since, I mean, as you saw, we're not really that big. In the grand scheme of things, $8.5 billion is not a huge company. But I think managements actually enjoy talking to us because we're not going line by line through their quarterly report and all that kind of nonsense. I think we have an excellent track record of undertaking these interviews and making them interesting. And we prepare so well for them that we don't waste their time. And that's a key factor. Now, in US large caps, increasingly, they only want to have sort of a Nuremberg rally for the CEO. So he comes in and, you know, he reads from a carefully scripted thing. And if you ask IR, they read from the same carefully scripted thing. And they only do this once a year at their investor day and all that. So we still have pretty good access to senior management, even among US blue chips, but they are trying to restrict it a lot. Regulation FD, ironically, full disclosure was one of the worst things for trying to actually get access to management, because they're increasing blackout periods and all that stuff. As far as a kind of a retail investor attempting to assess management, it's pretty tough to do. I mean, this is a tough thing to do anyway, right? It's tough to assess management from inside a company, let alone from outside a company. But I guess, you know, by their works you shall know them. So, you know, look at the track record and look at their compensation. I think you have to rely on those more objective things when you're a retail investor. And but I think, you know, generally speaking, people that have been around for a while and have a good track record should be the focus of your investments.
Thank you.
Hi, a question about working in the industry. Early on, what would you gauge as like what would you expect from someone starting out in the industry, maybe first 3-4 years, if you were to hire them?
Well, clearly, the first 4 years or so of your job, you're absorbing a vast amount of information, or if you're not going to stay in the industry. So you tend to put in the hours. I would say 60-hour weeks. It's not like investment banking or something like that, of course, but being in the office and working hard and learning and asking questions is key. We get people out very early on to see managements. Within the first few months, you're out seeing managements and watching the portfolio managers interviewing people. We have a whole program of things that our analysts do. They all go to Berkshire Hathaway. There's tremendous amount of reading to do. So on our website, we have a kind of a value investment library, and we expect people to have more than a nodding acquaintance with most of that. It comes down to a question of motivation and application, I think, and hard work and a love of the industry goes a long way.
Right. Thank you.
And also, of course, good luck. Like, for example, I joined the industry in 1984. And it would have taken a real screw up not to be a success in the asset management industry if you joined it in 1984. It was right at the first stage of the rocket ride, and it was going to be 16 years, and there was nobody there, right? Between 1966 and 1983, the Dow Jones average stayed below 1,000. The industry stagnated. Mutual funds, nobody invested in mutual funds. They invested in GICs and bonds because they got 10% doing that. Why would you bother investing in equities, right? So I was really lucky. Going into the industry now is a very different prospect, I would say. The industry's grown tremendously and, of course, completely disgraced itself over the last few years. And so it's definitely a tougher road to hoe.
Thank you.
Yeah, that wasn't the kind of thing you should probably thank me for telling you, but anyway.
My question is about the way you do your valuation, and in particular the way in which you value growth of companies, since that's how do you value the growth of companies?
Growth companies, yeah.
Well, not growth companies per se, but
what
the
we pay
growth
for
part of the valuation.
Yeah. Well, to the extent possible, we try to buy growth for free. So I guess if you're using an 8.5% discount rate, then other things being equal, if you pay 11.5 times earnings, you're not paying for the growth.
Right.
I mean, that rule of thumb, right?
Yeah.
So that's basically what we're trying to do. We're trying to minimize what we pay for the growth. But it's a good question. It's a tough question. Sometimes, sometimes the growth isn't there. Sometimes it hugely surprises you on the upside, like it did with Schindler. So maybe a more important thing for us is how do we adjust to unanticipated growth? We just came out with one of our views from Burgundy on the subject of SNC-Lavalin, which was a company that we bought for essentially nothing back in 1999, and it's been a 14-bagger. And it got that way because they bought 28% of Highway 407, and that turned into one of the best investments anyone could ever possibly have made. And they ended up being sort of a warrant on the global growth story. So their earnings went up 9 or 10-fold as well. So that's a big problem for value people. What do you do when everything goes right?
Right. Thank you.
Are you surprised with the strength of the rally in the markets over the past 2 years? And what was kind of your thought process when the markets were reaching new lows in late 2008, early 2009, and kind of when everyone else was jumping out?
Yeah, I was pleased with the way Burgundy reacted in late '08 and early '09. We were very professional. Nobody was jittery. Everybody was working hard. It was challenging because we were fully invested and we were having to, in this very uncomfortable world, if you wanted to upgrade the portfolio, you were selling stuff that was really, really cheap and buying better stuff that was also really, really cheap. So it was a real portfolio management challenge, but I feel the firm did very well. We were preserving capital. I mean, we were kind of a special case because we'd been very defensive for a couple of years before '08, which meant we lagged that late bull market, that crazy bull market that took oil to 150. So to us, there was a measure of relief in this because, you know, Canadian equities at June 30th were 17% behind the TSX. And by the end of the year, we're 6% ahead. So we'd had a 2,300 basis point swing in about 3 months. So we're a little different maybe because we were feeling relieved and motivated, and most people were feeling shocked and horrified. As far as, you know, the strength of the rally, I guess it shows that when governments decide to subsidize risk, people will take risk. And the governments have subsidized risk to an extent that is unheard of, unprecedented. I hope will never happen again. The approach seems to be that, you know, in the markets, I was telling George, is sort of whenever anything really, really awful happens in the economy, you wait until something worse happens so you can forget about the first one and just buy stocks. It's kind of a peculiar attitude, in my opinion. So, yeah, the fastest double in stock market history it's been. It's never happened before, but that's what happens with zero interest rates. So you've got the central bankers essentially forcing people out of risk-free assets into risk assets. And, you know, you can question the morality of that, among other things. But that's what's happened, and it's happened big time. The question is how they're going to retreat from this. There's some talk that QE2 will end in June. They'll just stop buying. That'll be a fascinating day in the bond market, I can tell you that. Because, you know, you take away somebody who's buying hundreds of billions of dollars worth of bonds, I suspect it may have some impact on the price. Anyway, it's interesting times.
Thank you. Hi there. When it comes to your investors, it seems like it's very much a partnership. They need to understand the long-term orientation of your fund, and you need to be speaking the same language. Do you keep them informed and committed through your design, or is it more, do you attract a certain type of client, and is there any sort of screening you do initially? Are there any kind of rules you guys keep to get the right clients?
Yeah, the most common Burgundy private client is generally an entrepreneur who's sold his business. It's somebody who understands what it is to manage a business, to allocate capital. They're quite often in a very uncomfortable position because all of a sudden they don't have a company to run anymore. They've got this big wad of capital. That's probably the most frequent type of investor. But there's really no general rule, you know. Common sense and a conservative approach and not getting whipped around by the markets are all aspects of it. I think we do a good job of qualifying our investors, and I think our investors are, generally speaking, you know, extraordinarily good and loyal. Generally, the longer we have them, the more likely they are to stick around. Anybody who was with us through the tech bubble, I think, is with us for good. So, yeah, it's the same kind of answer I gave to the gentleman about employees. A lot of people see the clients. We are constantly telling them, you know, this is what we do. If our returns are good, we'll tell them they're unsustainable. You know, all those kinds of good things. But and on the institutional side, it's the same kind of story. We're very unusual as an institutional investor because institutions tend to be very benchmark oriented. So what we have to do is find the right kind of consultant or the right kind of client within the institutional world as well. And there, you know, the institutional book at Burgundy has been every bit as loyal as the private client book. So I think we've generally done a pretty good job.
Thank you.
But you're right, we need like-minded investors, definitely.
My question is more towards the line of exit strategy. So when do you determine when to exit a position? Is it predetermined at the valuation or when the stock reaches its intrinsic value?
You know, it really depends how long it's taken to get there. You know, sometimes, you know, in the aftermath of the tech bubble, there were a lot of really good technology companies that got ridiculously cheap. They'd become nets, but they were so volatile. There was one company that I was into and out of 3 times in 6 months. I mean, I never do that, right? But what can you do? If you're buying at a 30% discount, it goes up 42%, it's at your intrinsic value, you sell the stock. Because you can't exactly argue that, you know, in my 6-week holding period, the company has vastly increased its intrinsic value. So, but that's a key point too, because if you've held the stock for a long time, if you know it well, if you're comfortable with management, and it gets to your intrinsic value, and you haven't refreshed your intrinsic value in a while, then, you know, we are reluctant sellers. So we'll look around. It could be that there's a financial buyer or a strategic buyer who's willing to pay up for those assets. And in that case, you know, we don't want to be chumps. So we'll maybe hold on to it for a while. But generally speaking, if it's at or above intrinsic value, it gets sold.
Thank you.
So we've witnessed a lot of great returns from great value investing shops, but for some reason we don't see a widespread adaptation of value investing theory. What do you think is the biggest obstacle to it? Why don't you see like everyone convert to value investing shop?
Why don't you see which? I'm sorry?
Why don't you see everyone convert to a value investing shop, but rather stick to traditional finance?
Why doesn't everybody become a value investor? Is that what you're saying?
Basically, yes.
Well, I tell my people that, you know, once you become a value investor, you've made a deal with the devil, because when you like your portfolios, your clients hate you. And when your clients love you, you hate your portfolios. That's just the way it is, you know. Because you're going to only like your portfolios when they're cheap, and when they're cheap, you've generally had a really bad experience. Like, you know, 2009, we were like thinking, wow, this is a fabulous portfolio. And our clients were thinking, wow, I've just been kicked in the head. By the same token, in sort of 2003, 2004, we had fantastic trailing numbers, but it was very hard to find value. So it's not easy at all. It's really a tough business. And sometimes if you are engaged in a contrarian enterprise and it's taking a long time to pay out, it's really difficult psychologically. You know, in 06, 07, early 08, you know, I felt badly for my people. They were under a tremendous amount of pressure. They're total professionals. They are very dedicated to having, and they're extremely proud of their track records. And, you know, we were having a tough time. We're always measured against these benchmarks. We do our best to ignore them, but our clients often don't. And a prolonged period of underperformance, which is what you have to be willing to accept as a value investor, is extremely difficult psychologically. So I think very few people are psychologically fit to do this. Plus, I mean, look, the easy thing to do is to get a whole lot of assets and then closet index and play defense. Pretend like, you know, you're 0.5% overweight in this is actually meaningful. Because these are great businesses, right? I mean, they generate tremendous cash flows, and, you know, if you have a $50 billion monster that's closet indexed, you've got a tremendous annuity, and that's the way a lot of people look at it. But value investors can't look at it that way. It's just not possible for us. So it's a great question. I don't know why there aren't more, but, you know, I look back and say, well, it's because it's a really genuinely difficult thing to do. Way harder than it looks. You know, 99, 2000, I mean, I was talking to George, you know, Nortel, you know, that thing it tortured me for 2 years. I really, you know, what about Nortel? That was all I heard about. And now it's gone, you know, 35% of the Canadian market, and it's vanished, and nobody even talks about it anymore. It's really frustrating. So, you know, kind of like you want to give a big speech on Nortel and John Roth and, you know, making decisions at web speed and all the other baloney he was spouting back then. And nobody cares. You know, memories are very short. It's what have you done for me lately? And sometimes as a value investor, what you've done for people lately doesn't look all that great. So it's tough. Yes, sir.
Right, my next question is about the management of the Burgundy business, and mainly how do you grow it? How do you attract new clients? I know you're not that active and you're not an asset hoarder, but at the end of the day, it's still a business.
Yep.
So
no, and you know, a little bit of growth is a good thing. Between 2000 and 2007, we grew from about $1 billion to about $9 billion, and that was a management challenge. You know, one of the problems is, as a value investor, you're often streaky, so you'll get a 2 or 3 year winning streak, and right at the end of it is when everybody wants to come and buy your products. So we deal with that by closing products. You know, our Canadian small cap fund was closed from September 01 to all institutions. So was our Canadian equity all cap fund. So we're always, you know, carefully trying to control growth. As far as how we attract clients, on the private client side, the wealthy individual side, it's totally word of mouth.
Okay.
So your existing clients are your best salespeople. On the institutional side, there's sort of an infrastructure for that, where you talk to consultants and you know, show them your wares and all that stuff. That's a little tricky because you want to be true to yourself, and we are a very unusual organization compared to most of the ones that they would look at. You know, we are so non-correlated that you know, we scare them quite often. But you know, we have there are some consultants that are a pleasure to work with. They really get it. They really understand where a Burgundy would fit into their clients' needs, and we can help each other in those circumstances. But so those are the two main areas. We also will visit plan sponsors. You know, there's a few large investors in most cities. You know, universities and large corporations and healthcare institutions, where you can go in and see the people that are in charge of the investment side of things, and that can quite often lead to business as well. So, yeah, we're not averse to bringing in new business, but we're not a marketing organization. We're an investment organization.
Hi, a question on pitching ideas. In terms of, if someone were to pitch you an idea, what would be just the right amount of information to give you? Like, not too much, not too little, not too short, not too long. And then what kind of indications, like if we're a student and we're trying to pitch you an idea, what kind of indications would you give that this is a legitimate idea based on the business and the price? And what indications would you give if you weren't interested?
You're talking about like when one of my analysts comes in to talk to me about something?
Sure, or even if one of us were to pitch you an idea.
Yeah, well, that's something that actually people have to do to invest in, to come in to interview on the investment side at Burgundy. We actually give them a project. Once we get to a certain stage, we give them a project and they write a report for us. There's a few different reasons for that. One is to see how they think about companies. You know, we don't want somebody who's giving us a mass of Greek letters and numbers. So we want them to be able to formulate a qualitative thesis for a company and express it. You know, I think Tony Errol, our chairman, is of the opinion that value investors, really good value investors, are always pretty well-spoken people. And Buffett's sort of the supreme example of that. They can express their ideas very clearly. I'm not so sure that we're even looking for, you know, whether or not it's a good investment idea from someone like that. It's more we're looking for how they think about companies and how they've approached the whole analytical process is what's more interesting to us. You know, good investment ideas, frankly, are extremely rare. And they can come from any place, including, you know, members of your family or anything else. But, you know, really good ones that are long-term winners are extremely rare.
Right. And just to follow up on that, when someone does give you a good idea, like what kind of indication do you give? Does it usually hit you right away, or you go back into your office and then you realize that was a good idea?
Oh, the eureka moment.
Yeah.
I think you usually know it when you see it. Yeah. I don't think you... I had the great luxury when I was managing Canadian equities at Burgundy that I had a guy called Alan MacDonald who was my research analyst. And Alan has become our sort of small cap guru at Burgundy and has this outlandishly good record going back. He's got his small cap Canadian fund has a 22% compound 16-year record now. I mean, it's just unbelievably good. So, but he also had this capability of being able to walk into my office and in, I swear, a couple of minutes, give me everything I needed about a company. I mean, it was extraordinary. Now he's an unusual talent, and I don't expect most people to do that. But I think that sort of encapsulation is useful, and I don't think it's a case where you can be sold a bill of goods. I think, we know what we're looking for, and we know it when we see it. It tends to be recognizable right away.
Right. Thank you.
Hi. So going into 2007, when the market is now clearly known as overvalued, did you see any of the warning signs that were, and how did you go about finding value at this time?
Yeah, it was a really frustrating market because it was very undifferentiated by value. So it was very hard to find pockets of value, with the exception of Japan, the eternal exception of Japan. We didn't do a good enough job of recognizing the systemic risks like Prem Watsa did. Prem has done an unbelievable job of seeing around corners. The risk that we were mainly concerned with was the risk from commodity collapse. So if you look at those numbers, the reason that we had outperformance was not so much because we avoided the financial chaos, although we did in Europe and Asia. We had some exposure in Europe and Canada, but mainly because of the commodity price collapse. So yeah, we were, I told people I felt a little bit like the French army on the Maginot Line. I was ready for them, and then they went around the flank with the financials. But that was, that was a really terrifying thing. The only place to really hide was cash and government bonds. And aside from Prem, I don't know of anybody else that did that. Do you, George? I don't think so. So we preserved capital and we protected our clients against some risks, but I didn't read the tea leaves nearly well enough on what was going on in the U.S. financial sector. I mean, I guess you really couldn't have credited that the entire country would be complicit in what was going on in their housing market. I mean, everybody lied. Right? People that filled out the forms lied. The people that took the forms accepted the lies and sent it to other people who accepted the lies and then loaned on the basis of the lies. And Congress wanted the lies to work because he wanted everybody to own a house, which is a stupid idea in the first place. So
I'm not judging or anything. I'm just.
No. But it's a great question because, all George was talking about the little Congress that you guys had in 2007, and Prem came in and said, "This is nuts, and the mortgage-backed securities market is completely insane, and anybody who has any exposure to it at all, either directly or indirectly, is going to get killed." So it was right there. You could have listened to him, but and I guess in our U.S. side and our Asian side we did, but we did end up with a little bit of damage from that. So didn't do as good a job as we could have. Never do, mind you, right? So, and Prem sort of hit the ball out of the park. That was magnificent by him.
Okay, thanks a lot.
Okay, we're running out of time, so just a couple of questions. Now, for you, I guess, how important is the economy, and has your view changed since 2008?
we like to say that we see the economy through the eyes of the companies we invest in. So, I don't look at, the employment report comes out, so I sell equities. But if we go to a company and they say employment is one of the key things you should watch in determining, like for Western Union, for example, where employment is a very serious matter for them, it accounts for all their cyclicality, or an ADP, where they're a payroll company. In those cases, we know what drives the business. That's really what it's all about, is trying to find from the companies what are the economic drivers, and then whatever economic data might actually have some impact on their fundamentals. As far as changes since '08, the big one is what we were talking about at dinner, which is, big balance sheet financials. People like us place a lot of emphasis on knowing what's going on in the companies we invest in, and you do not know what's going on in a big balance sheet financial. You can't know what's going on in a big balance sheet financial. So the question is, how much banking exposure, life insurance exposure should you have? And I would say our answer to that has been not nearly as much as we had in the mid-2000s.
Okay, and the last question. What is the most important thing you learned in investing and in life over the last 30 years of your experience?
Ethical behavior. I think if your job reflects who you are, and if you always do what you say you're going to do, and if you recognize that you're really, really lucky to have gotten into a business like this, a business this good, and that, that great thing that Buffett said about, the never doing anything that you wouldn't want to appear on the front page of your hometown newspaper. I think that that alone is going to lead to a good business career no matter what you do, no matter what the outcome is, no matter what the luck you have, I suppose. But I tend to think to some extent, you get the luck you deserve.
Well, thank you very much, Richard, for this informative and presentation and the interaction with my students here. As I say every time, these guest lecture speaker series are very important for my course because beyond the numbers, I want the students to see the personalities, the temperament, the character of the value investors, and internalize the character development and try to instill in them. So thank you very much for helping me do this. On behalf of all of us, a small token of our appreciation as a memento of this event. Thank you very much.
Thank you very much. Thanks, Jim.